Hello, and thank you for joining us at xam.com for this special report. Q3 earnings has come to an end, and markets breathed a sigh of relief as the worst-case scenarios were not reflected in the results. But what could that mean for stocks moving forward? I'm Christina Marujos. Joining me today is our investment analyst, Stefanos Economidis. Stefanos, Q3 earnings were not as bad as feared. However, the bar was set pretty low to begin with. Therefore, attention is now shifting to what lies ahead. Could Wall Street afford another quarter of such low expectations?
Hello, Christina. You are absolutely correct. Most listed US firms managed to clear the low bar set by markets in the latest earnings season. Interestingly, some market participants fear that we could see an earnings apocalypse in Q3 as the macroeconomic conditions have been constantly deteriorating in the last year. Even though looming fears of an impending earnings crash were not reflected in the corporate outlook, firms that missed projections or provided poor guidance were severely punished by investors. That being said, as more and more industry leaders are starting to downgrade their forward-looking financial estimates, bracing for slower demand and narrowing margins, I don't believe that stock markets could get away with another poor earnings season.
Markets are seeing investors' interest rotating from growth stocks to value. Do you think that Q3 earnings reinforce this theme?
It has been historically proven that value stocks outperform growth in periods of economic distress, and the latest earnings seasons reaffirmed this theme. Apart from being pressured by rising interest rates, tech giants also got hammered due to their inability to sustain their spectacular pandemic performance. At the same time, defensive sectors continue to fare well as they can pass on higher prices of essential goods to their consumers. A clear example are the energy firms that have crushed estimates and trade in record high levels, even though oil and natural gas prices are currently trading far below their 2022 peaks.
And lastly, let's look at the outlook. A softer than expected CPI print last week gave markets reason to celebrate, and of course an impressive rally ensued as bets of aggressive Fed rate hikes scaled back. Could we be entering a trend reversal?
During the latest earnings seasons, we had two major shifts in investor sentiment. At first, stocks lost ground after the Fed proceeded with a 75 basis points rate hike and stated that a slowdown is not on the cards yet. But as you correctly mentioned, the softer than expected CPI print triggered a moderate rally on increasing bets of a Fed pivot. Now, I think that it's too early to speak about a trend reversal because the gloomy economy is on the verge of a recession and there won't be any fiscal or monetary help this time, as this would reignite inflationary pressures. Don't forget that consumer demand is already weakening, while geopolitical risks and jitters from China's zero-COVID policy are unlikely to end soon. To conclude, I think that midterm elections and the Fed's pivot could lead to a short-term advance for stock markets, but they are not surely out of the woods yet.
Stefanos, thanks so much. This was a special report here at xam.com.